makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Now, the dollar drops, treasuries gain as investors look ahead to a U.S. inflation report expected to show headline and core CPI easing in June, the latest key data before the next Fed decision. Ukraine's president says he plans to fight more security guarantees from G7 allies as NATO outlines plans for its future membership. Plus, Microsoft moves closer to finalizing its $69 billion bid for Activision, winning a U.S. court fight and an unprecedented review in the UK. So let's take a look now at the European markets map. A lot of the drivers we're seeing in today's trading session really driven by technology, but also some of the commodities. The big story, as always, is not only what's happening with China, but also a little bit of pressure across the board. Then we have CPI. I have a great terminal chart looking at volatility ahead of that U.S. inflation print. But we also have Andrew Bailey, the governor of the Bank of England, speaking right now on the financial stability report. So here he is. Let's listen in.
The judgments that the FPC has made on the resilience of the UK banking system, including obviously the results of the stress test and the decision we've taken, as we always do, on the countercyclical capital buffer. Moving then on to the lessons we've learnt to date from the recent stress in the global banking system, and then finishing up on the continued importance of addressing vulnerabilities in the non-bank financial world. So on that basis, let me start on the key developments so far this year. So we've had obviously further rises in global interest rates, reflecting actual and expected increases in central bank policy rates. In the UK, returning inflation to target sustainably will, of course, support the FPC's objectives as well as the MPC's objectives, because it will support protecting and enhancing financial stability in the UK. Now, the increase in interest rates and market volatility over the past 18 months has, as we've seen, created stress in some parts of the financial system. And we did, of course, in March have the failure of three mid-sized US banks and Credit Suisse. That caused a rise in risk premium and volatility around March. But our judgment is that the impact of that stress in March on the UK banking system was limited, and that since then, globally, market risk sentiment has stabilised. And more broadly, the UK economy and financial system have so far been resilient to interest rate risk. Compared to previous periods of high interest rates, households and businesses are less likely to cut back on spending and default on loans. And I think there are really two reasons, important reasons, to draw out here for this. The first one is the resilience of the banking system. And that means that the banks have options to offer support to their customers. A more resilient banking system has more options in that sense to support its customers. And the second reason I draw out is that the FPC and the FCA's mortgage market measures have limited the build-up of household indebtedness and increased borrower resilience. So the 2 points I'm drawing out really are lender resilience and borrower resilience, and they of course go together very closely. But it is the case that elements of the global financial system do remain vulnerable to increased interest rates and uncertainty surrounding the economic outlook and, of course, tensions geopolitically speaking. And really, as we point to in the FSR, we point to riskier corporate borrowing in financial markets, such as leverage lending, as an area of vulnerability that has to be followed closely. Global commercial real estate markets, which face a number of short and longer term headwinds that are pushing down on prices and making refinancing more challenging in that world. And I think we do have to bear in mind that it will take time for the full impact of higher interest rates to come through, both in the UK and in other advanced economies. And so the FPC will remain vigilant to these risks and these processes taking effect. So let me move on then to the UK banking sector and its resilience and the stress test and the CCYB decision. So in the UK, we've taken steps over time, of course, to ensure that the banking system is resilient to these risks and that it maintains robust capital ratios and liquidity buffers. And the results of the stress test that we've published today show that the major UK banks are resilient to a severe stress scenario. That scenario incorporated deep simultaneous recessions with materially higher unemployment in the UK and global economies, increasing global interest rates, persistently higher advanced economy inflation, and sharp falls in asset prices. Now, I would particularly note that while interest rates are higher today and therefore closer to those which we published in the scenario, that is higher than when we first outlined the scenario is significantly more severe than today's conditions. And a very important point there is that it's the combination of higher interest rates and simultaneous recessions around the world and in this country, and materially higher unemployment that makes the stress. It's not one thing on its own. That's the key point I would bring out there. Second, we're announcing that the FPC has decided to maintain the UK countercyclical capital buffer rate at 2%. This will help to ensure that banks have sufficient capacity to absorb future shocks without unduly restricting lending. And of course, as ever, we stand ready to vary that CCYB rate in either direction, in line with the evolution of economic and financial conditions, underlying vulnerabilities, and the overall environment for risk. Now, we have observed some tightening of lending standards from banks over the past few quarters. But our judgment, and we have to make this judgment every time, is that that reflects appropriate risk management in line with changes in the outlook for the economy and the world. It's not a case of restricting lending primarily to protect capital positions, and it's that distinction between risk management and capital protection that is critical here. But of course, we will continue to monitor credit conditions for any signs of tightening which are not explained satisfactorily by changes in the macroeconomic outlook. So the overall risk environment is challenging, and that said, we continue to judge that the UK banking system has the capacity to support households and businesses through a period of higher interest rates. And the stress test shows that that would be the case even if economic conditions were substantially worse than we currently expect. And move on to the left.
Well, you can continue watching Andrew Bailey's press conference on the BOE's financial stability report on your Bloomberg terminal on Live Go, LIV Go. The governor there talking about rising rates having created stress on the financial system. This is, of course, something that we've been watching very closely. He also says households and businesses are less likely to cut back. The global real estate faces a number of headwinds. And I think also in earlier remarks, he was mentioning shadow banking. Now, joining us to talk about the UK and, of course, looking forward to the CPI data a little bit later from the US, we're joined by Anneka Treon, Chief Economist at Lanschot Kempen, and Bloomberg's John Stepek. So thank you both for joining us. John, you've been writing extensively about mortgages and, of course, about this conundrum in which the Bank of England is at. I mean, it seems that the governor is now pointing to worries, outside the financial system, the non-regulated shadow banking things. Could it get ugly?
I mean, in terms of mortgages, that's unlikely. I think one of the interesting things about this, and also from the stress tests, is it's very clear that the mainstream banking sector in the UK is resilient. It's very hard to make the argument that there are any obvious issues there. Going outside, that does make you think, well, some of these risks must have migrated elsewhere. But at the end of the day, most mortgage lending in the UK comes from the mainstream banks. So I can't see any major issues kind of arising from the kind of shadow banking sector from that point of view. As far as other areas go, then possibly, potentially. But I think you can see that that's something that the Bank of England will be trying to focus on a bit more. It's just very difficult to get a handle on that particular sector.
Yeah, so Anneka, when you look at the Bank of England, outside the stability report, of course, they still have to deal with a higher inflation figure than many other parts of the world. How difficult will it be for Governor Bailey to get it just right?
Hi, Francine. Well, let's zoom out. The UK is one of the only major economies in the world where inflation is actually still accelerating. And that makes this whole thing very, very complex because other countries have actually surpassed that peak. And it's still a price discovery environment. And the last CPI print was a shock. And I think it's all about core inflation. And if you look at the levels of core inflation we're at in the UK today, and remembering what Rishi Sunak said back in October, he was committed to halving inflation because we all know how painful it is. It's not an easy one to tackle given the stickiness that's around.
Yeah, and of course, $1 million question to John, I'll start with John, is an end to tightening, but when? We also spoke to Adam Posen, actually, former MPC member, one of the most respected economists out there. And this is what he had to say. It's our morning must listen in the City podcast. So we basically talked about the terminal rate, and he says they have to get to well above 6%. If anything, the fact that inflation is proving more persistent may mean that they will have to go higher. One of the investment banks published something saying maybe 7%. I would not rule that out. That was Adam Posen. I mean, it's pretty punchy. This is after JP Morgan said they could go down to 7%. What does 7% interest rates, terminal rate, mean for mortgage holders?
I mean, a 7% terminal rate for somebody that has a mortgage would be brutal. I mean, one of the problems here is that the mortgage market, the housing market itself, is actually very resilient in aggregate relative to the last crashes in the 90s and 2000s. And that is because basically fewer people have mortgages. It's down to about 28% now, whereas it used to be kind of nearer like 35, 36% before the 2007 crash. Also, those mortgages are more conservative. So the people who have them are wealthier. They were written at the kind of higher loan to value, so lower loan to value ratios. Before the 2007 crash, there were significant numbers of interest only 100% mortgages. Now there are basically none. So the point is that that's all good. But the problem is that if part of the transmission mechanism is meant to be you drive up the cost of living so that people spend less and you reduce demand in the economy, then that actually makes it much harder because that transmission channel is almost clogged up. Because and also all the fixed rate mortgages, because they don't come off. I mean, some of them won't be coming off until 2026. So it just takes a much longer time to pass through.
So, Anneka, what does this mean? And we hear this more and more. If you look at valuations, there's been so much said about the fact that UK is going through troubles. Is it now actually a buying opportunity? Because things could get easier quicker than people think.
Yeah, well, it's two things, and it's also what Andrew Bailey was referring to. One thing is time lags. The transmission mechanism of sharper rate hikes and how that impacts the real economy. There's a huge time lag around that, 6 to 12 months, if not longer. So we're yet to see what the pain is, and that also applies to corporate earnings. If you look at the general and aggregate corporate earnings season, we keep anticipating that the next one is going to be painful, and it never is. And you're starting to see earnings downgrades come in, but that's critical. And the other thing that Andrew Bailey said, which is important, is it's not just one thing. And one of the reasons why it appears that the economy is actually holding up reasonably well, despite these horrific inflationary numbers, is because you've also got the fiscal policy side of things. So while central banks might be very, very hawkish lifting rates, if fiscal policy is, as it is today, accommodative and remains accommodative to protect the consumers whose real wages are continuously declining, even though labor markets are strong because inflation is so high, that is an offsetting factor. And that's why, from a stock selection perspective, looking at UK equities, you need to go really nitty gritty and see what's happening on the idiosyncratic basis with those two forces.
All right, Anneka and John, thank you so much. John Stepek, Anneka Treon, both stay with us. Coming up, US June CPI due later today. We look ahead to whether the Fed is winning its fight against inflation. That's next, and this is Bloomberg. Investors look ahead to a U.S. inflation report expected to show headline and core CPI easing in June, the latest key data before the next Fed decision. Now, stocks mostly higher. The dollar hits the lowest since February. Now, still with us, Van Lanschot Kempen Chief Economist Anneka Treon and Bloomberg's John Stepek. So when you look, Anneka, at some of the headline inflation, the fact that they're coming down, but a lot of questions on when the Fed can cut rates. Is it one and done, and then they wait to see the full impact of tightening they've done so far?
Yeah, and then it's all about whether we're going into the terminology of pause or skip. And actually there, Powell made a slip of tongue in the previous meeting, which was fascinating because he referred to a skip versus a pause and then corrected himself. And that's what it's all about. And it all hinges upon one thing, and that is the core inflation number. And that core inflation number has been moving quite sideways. The 4.6% is way above what the target is. And the question is, are we going to continue to be hawkish central bank officials themselves are expecting 2 more rate hikes this year to manage that? Or are we simply going to tolerate the fact that 2% is just not realistic for the coming period?
Yeah, and John, it goes back to the fact that actually and I think we have 4 Fed speakers today, so that'll be interesting to see how they, how they position that. But they keep on saying, look, we're not done tightening. Inflation is still sticky, and even if it goes to 5%, then the 5 to 2% is going to be quite painful. But the markets still don't believe them. Yeah,
well, I think that's partly a hangover, because I still think that the market in its gut can't quite get over the fact that the 2008 era is over. So the way we even talk about this is, so there's going to be a peak and then immediately rates are going to start coming down. Well, why? There's no reason for them to start coming down unless the Fed actually triggers a recession. So I think it makes sense for the Fed to at least present a hawkish sort of kind of jawboning, as it were, to at least keep markets on their toes. But John,
is there a transmission mechanism problem? And, I was in Sintra, you keep on hearing from central banks also higher for longer, because I guess they're worried that what they're saying and doing isn't really translating to consumers.
Well, the thing is, if consumer spending is healthy, the only way to stop consumers from spending is to actually reduce the amount of money in their pockets. And of course, part of the problem with that is that, it's politically unpopular. There is almost no way that a central bank in any of the countries is now going to get the idea that, OK, if we want to stop people spending, we're going to need to trigger job losses. I mean, you've seen lots of stuff about how all the Taylor rules made up. There's no necessary relationship between unemployment and inflation. But at the end of the day, if they need to batter it down, the only way to batter it down is by causing recession. The question then is, going back to Anneka's point, do we just let inflation hang around at about 3 or 4% rather than 2%? But you can't state that, I think, is the problem.
Yeah, and also, I guess, consumer shopping habits. I mean, we had a fun little story about Barbie and Oppenheimer, how the young kids are seeing like both back to back, one on nuclear war, the one Barbie and Ken. I mean, are you doing that?
I'm looking forward to a feminist reinterpretation of Barbie, absolutely. Yeah, I'm booking them both.
Anneka, I mean, we just don't really 100% still understand how people are shopping differently. If it's, of overhang, notwithstanding Barbie, an overhang of COVID.
Yeah, and it's exactly what John said. I totally concur. It's all about what's happening to consumers' pockets. And while the Fed is raising rates, fiscal policy is still doing its thing. There's more than $1 trillion being spent, eventually leading to job creation through Inflation Reduction Act, national security measures, infrastructure measures. January, households continue to receive checks, and that's continuing also in the recent months. So that creates this sort of juxtaposition, and therefore we shouldn't be surprised that consumers are still spending if they've got the cash flow to.
Anneka and John, thank you so much. Anneka Treon, Chief Economist at Van Lanschot Kempen, and Bloomberg's John Stepek. Now, coming up, we'll bring you the latest from the NATO summit, where allies have agreed a plan on Ukraine's future membership bid. That's next, and this is Bloomberg. NATO leaders continue their meeting in Lithuania today after allies agreed to offer Ukraine a faster path to membership when allies agree and conditions are met. However, that risks falling short of Ukraine's hopes for the summit. So let's get more from Bloomberg's Maria Tadeo in Vilnius. Maria, you've also spoken to a number of leaders there on the ground. To what extent does the current agreement by allies fulfill Ukraine's wishes?
Yes, Francine, and President Zelensky is now here. In fact, he had a bilateral meeting, one of the many that he will have today with the German Chancellor. Remember, today will be about those bilateral and potentially even G7 security guarantees for the country. But when it comes to the communique, and you expressed it very well, is that sentence, when allies agree and conditions are met, that is not something that has been widely accepted by the Ukrainian delegation. It was palpable in the body language from the Ukrainian president today. He briefly spoke to the media and repeated, I have a 3-point message that I want to convey. It's more weapons to Ukraine, security guarantees, but also that invitation to NATO. Quote, I want to make sure we're on the same page. The problem for President Zelensky at this point is that the text has been endorsed by NATO. It is closed. It is done. And this negotiation in the eyes of NATO allies is done. But as you can see from that wording today from the president of Ukraine, he is not willing to drop stop this fight yet. Now, we'll see at the end of this meeting between NATO and Ukraine whether he's able to get something more. But for the time being, you do see this frustration from the Ukrainian delegation.
Thank you so much, Maria Tadeo. They're on the ground in Vilnius. So now stay with us as we speak to the Latvian Prime Minister a little bit later today, also on the sidelines of that NATO summit. Coming up, we discuss the AI boom with Raj Verma. He's chief executive of database company Singlestore. That's coming up next, and this is Bloomberg. The dollar drops, treasuries gain as investors look ahead to a U.S. inflation report expected to show headline and core CPI easing in June, the latest key data before the next Fed decision. Ukraine's president says he plans to fight more security guarantees from G7 allies as NATO outlines plans for its future membership. Plus, Microsoft moves closer to finalizing its $69 billion bid for Activision, winning a U.S. court fight and an unprecedented review in the UK. So good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, as we've been discussing on the show this week, the AI boom is a key driver of this year's rally on the NASDAQ. One of the most prominent names calling for caution in artificial intelligence, Elon Musk, is speaking with two prominent U.S. lawmakers today about the benefits and downsides of the technology. Now, joining us now to discuss all of this is Raj Verma. He is chief executive of Singlestore, a database company whose software powers the likes of Uber, Siemens, and a number of banks. So, Raj, thank you so much and welcome to The Pulse. I know you are one of the leading voices to understanding AI and generative AI. It's often just very simplistic. Is it good or is it bad? Does it take time to actually understand what we're dealing with?
Yeah, I think overall generative AI is good. Good for humanity, good for business, good for society. Like with anything, Francine, there are going to be people who are going to take advantage of that if that is not used in an ethical manner. And as I have always said, that I think the 3 E's of generative AI, which is education, most importantly, ethics, which are, I think tech leaders like us and many others would be faced with that decision, whether you could use AI for quote-unquote nefarious purposes or to do good. And I do think that overall generative AI is good for society, good for business and mankind.
But Raj, there'll always be someone trying to use technology for the bad, right, for nefarious things. So how do you regulate that? And can you only regulate the bad part, the dark part of AI?
Yeah, I do think that this is going to be an unprecedented challenge that we face, Francine. The society and civilization has actually never really faced a challenge like that. And this is not being hyperbolic in any way, shape, or form. Fortunately, I have access to some of the upcoming versions of ChatGPT and other tools. And some of the power that it has, if put in the wrong hands, could have a pretty dark impact on, actually, funnily enough, the more vulnerable in society, unfortunately. And we've seen examples of that. We were talking about kids.
Yeah, do you think this is fake news? I mean, one of the funniest, but also most tragic stories, I think, is one of the first reporters, using ChatGPT, where they basically convinced him that he should leave his wife because he was in love with the software. I mean, I know we'll come a long way, but again, how do we know what's in it?
Yeah, I do think that is probably an edge case of an example, but it gains a lot of popularity. It's very funny, and I found that entertaining as well. However, I mean, you don't even have to go that far. I mean, we've already seen in society, and something which is very, very close to my heart, the mental health issues in teenage girls. I mean, you and I were talking about kids right before the show started. I'm father of 2 girls, and the suicide rates in girls, teenage girls, has gone up 10x in the last decade. And a lot of that is attributable. And that's, by the way, 10 times since we started keeping records for the last 120 years. And a lot of that is attributed to social media and to the fact that they have propagated a certain body image, a certain sort of fear of missing out propaganda. And that is, in a large way, attributable to data and data being used for a certain purpose, which is really profits. And as long as companies do not take a broader view of the impact that data has on society, we are going to have those issues. I'm not one for regulation, but I do think that we should have a robust and energetic conversation about the sort of S word even, sanctions, when it comes to use of AI.
But this would be what for, again, countries that are non-friendly countries, or is it for private companies as well? I mean,
private companies.
Sit on so much data, right?
I mean,
and you don't really know, once you put the data, even on education, we were having this conversation with an education specialist saying you lose a lot of the cultural subtleties, right, if it's all generated by one program. So you reach much more, parts of the world through education, but then it all becomes one society almost.
Yeah, it does. I think some of the organizations with the data that they have can be more dangerous than some of the countries. In fact, a lot of countries put together. Yeah. So I do think that it's not only countries. I think it is organizations as well, because I think they have outsized influence on society and on the way we perceive data,
Raj, how do you think AI actually changes your business and tech companies in general? I don't know how many jobs will be lost. Again, it's unclear how fast or how much of an early adoption this will happen, and whether the numbers we look at are too cautious or actually just a bit crazy.
Yeah, I think there are multiple questions, all good ones here, Francine. First and foremost, I do think that AI and all the buzz around AI is very, very justified. And I do think that if you are going to see generative AI and AI as a silver bullet, which is going to make up for the sins of the past that your organization has had, not putting data in the center of your strategy, I think that is a false premise. If you haven't put data in the center of your strategy for the last few years, you are going to find the adoption of AI that much more difficult. However, for organizations who have had a pretty good, robust data estate, they would actually take advantage of this AI boom and be very, very successful with whatever it is that they do. One of the things that I've been propagating is there isn't a greater time to align your value proposition with your values proposition. And I think it is more important and pertinent now than ever before.
But what does that mean, Raj? Because then you hear of companies, that have been certainly pushing ESG products in the US, and because of the backlash, are now too afraid of doing it. So values are subjective, certainly in a divided society, and chief executives sometimes shy away from it if it means lack of business.
I completely agree with you. I do think that this is not an easy problem to solve for. I do think that, the values at the highest of level, Francine, are, I don't think you should harm people. I mean, that's not even expecting too much from corporate America or the corporations at large. I do think that a lot of this happens without the office of the CEO involved. So I do think that clear communication, which aligns your value proposition to your values proposition, is important. And I do think that a lot of good organizations are communicating a lot more about how they would use AI. And by the way, just one last aspect. A lot of people tend to think of AI as something absolutely magical, Star Wars-like. One of my favorite examples is a very large automotive company in Europe. They were like, what do we do for AI? And one smart engineer said, came back to the board in a week's time and said, let me show you a demo. He put all the manuals of that car manufacturers for the last 30 years into a corpus of data, and then you could actually have agentive tech on it. So now the latest models that you're going to get is you could actually press a button and say, how do I change the oil in my car or unlock the child seat or what have you? And it just speaks back at you. Yeah. So you aren't going to be peering into, sort of manuals and doing it. So that's a very simplistic use case, which has a huge impact on customer sat sector.
I mean, I love that. I need that for the IKEA furniture building. So how does it impact a lot of your customers? I know you have Uber, Disney. How does it change Singlestore going forward?
Yeah, for us, the one thing that is extremely important in AI is ultimately speed and the recency of data. And what Singlestore is built for is the ability to be able to transact, analyze, and contextualize data in one platform without moving data in millisecond response times. And I mean, 60% of our revenues come from Fortune 500 customers. But I want to be extremely clear. I do think that AI does democratize the playing field between the Fortune 500 companies and the rest of the companies. A large number of our customers are non-Fortune 500, 40% of them, and they are using AI very effectively for personalization, for customer, sort of interaction, for customer sat, most importantly, for risk, for compliance, for governance. And as I have said, companies with a very, very pristine data estate are able to get onto that a lot quicker.
Raj, you're also an entrepreneur, right, at heart, and this is like every fiber in your body's entrepreneur. I wonder whether you worry about a lack of funding because of the collapse of SVB. And whether that's, and we're hearing some of the big banks are trying to, hire strategically here and there, but what does it mean for the fabric of entrepreneurship in Silicon Valley?
Yeah. So I want to make a couple of points. Silicon Valley Bank was an unbelievable partner to me. Yep. So I owe them a lot of gratitude. In fact, we took out ads and all the rest of it when it collapsed. And it's very sad to see that bank collapse. It was, you couldn't orchestrate a better bank run if you are run at the bank, if you tried.
Operationally, I mean, they did some stuff that they shouldn't have done.
Exactly.
Otherwise,
they made mistakes.
Wouldn't have collapsed, right?
They made mistakes.
Right.
It was accentuated by, the current sort of social media, etc. I mean, we do have to understand that was venture debt for the most part. I do think Sand Hill Road and the venture capital world is very, very buoyant with money. In fact, every few hours I hear of yet another, fund being raised to fund AI. I was just reading this morning that a very dear friend of ours raised $2 billion only to be invested in AI. So I don't think Silicon Valley is going to have a dearth of venture capital in the near future.
Does it feel like it's in a bubble sometimes? I mean, I was also reading there is a French company that I think has been on its feet for about 3 months, raising a lot of money. Like, how do you know where this ends if it's only a fad?
By the way, I think that French company you're talking about is a large customer of ours, and we are very proud to have them. The fact really is that venture capital, just by virtue of what it is, a large amount of their investments fail. Yeah. So they are dreamers. They are the ones who sort of tend to push the envelope. And the one that strikes is the big one. So that is just the business model. Does it feel like a bubble? I live there. My kids live there. Yeah, sometimes it does. It's sometimes just living on the edge. However, I do think that the basic fiber of people who change the world are the people who believe they can. Is probably more true in the Valley than anywhere else that I have lived, and I've lived in 6 different countries. So I do think that the Valley is just about getting started. So the demise of the Valley is highly exaggerated.
All right, watch out, world. Raj, thank you so much for coming on for a fantastic conversation. Raj Verma, their Chief Executive of Singlestore. Coming up, game on, the FTC is leaning towards appealing a U.S. ruling approving the Microsoft Activision deal, so we'll have plenty more on regulation and, of course, that space. This is Bloomberg. The conversations that matter, the insights you need. This is a Pulse. I'm Francine Lacqua here in London. Now, a U.S. judge has given Microsoft's $69 billion bid to buy Activision the green light. But Bloomberg has also learned that the FTC is leaning towards appealing that decision. Well, joining us now is Alex Webb from Bloomberg Quick Take. Of course, he focuses on all things technology. So, Alex, how likely and how fast could we actually see an appeal? And good morning.
Good morning. It's hard to know how fast we'll see an appeal. According to Bloomberg's reporting, the FTC is leaning towards an appeal. It's interesting if they do, because Lina Khan, the head of the FTC, is pretty strategic. She, on the whole, doesn't go for cases that she doesn't think she can win. But this is quite a big clearly quite a big deal for the FTC. They have been slightly changing the way they approach big tech in particular. In the past, there was perhaps a view that some mistakes were made. Maybe they shouldn't have approved Google's acquisition of DoubleClick. Maybe they shouldn't approve Facebook's acquisition of WhatsApp and Instagram because of what they let those companies become and let them dominate the space. So perhaps that's why they're willing to sort of, to invoke a phrase, go to the blankets on this one, go to the mattresses, I apologize, on this one.
So what does it mean for the deal, actually?
I mean, at the moment, it looks pretty likely this deal is going to happen, particularly given what we're seeing in the UK. In addition to that,
right.
What's happened is that the UK is essentially giving them a stay of execution, giving them another chance to come back and offer some concessions. There have been some question marks about the way that the UK regulator had approached it from a legal perspective. Maybe they hadn't been quite as prepared as they might have been. But there's some political involvement here as well that is kind of hard to, it's not impossible, but it's hard to block something when the US is kind of letting it go.
And at the same time, we also have the FT reporting that ARM is in talks with NVIDIA for it to be its anchor investor for the IPO.
Yes, which is, we've seen SoftBank trading up on this as a consequence. There's been some pressure from activists over the years to just kind of get ARM off the books. They haven't really managed to do as much as they had promised when they acquired it a few years ago. The interesting thing here is that the reporting from the FT suggests that they're looking to come in at a price of between $35 and $40 billion, which is kind of very close to what SoftBank paid to acquire ARM however many years ago. ARM seeking something closer to $80 billion. And of course, when NVIDIA, don't forget, they had agreed to buy ARM. That was blocked by regulators. The price they had agreed to buy it at was essentially $66 billion. So quite a discount to that. But nonetheless, it would provide that sort of grounding which would help it at the IPO.
Alex, overall, when we look at some of the reporting that we have for these IPOs, but also these mega mergers, like, does it feel like we're in a bubble, or what does your reporting suggest?
The thing that's interesting about the IPO stuff is that, particularly if you look at stuff that's privately held and stuff that's held by private equity, if you think about Yahoo, for instance, also reportedly, they have said publicly that they're looking to IPO, currently owned by Apollo. Because there are lots of private equity firms, and maybe you could include SoftBank in that, looking to actually return some money to investors, cash out a bit. The assets that aren't the premier assets, the ones that they actually don't want to hold on to in perpetuity, they're looking to find an exit. Now, it's very hard to find buyers for these assets right now, which leaves the IPO market. Nonetheless, we've not seen many of these companies go to market in that sense, but it does really seem like the option of last resort.
Alex, thank you so much. As always, Alex Webb there from Bloomberg. Quick take. Now, another story we're watching, Microsoft also says a China-based hacking group intent on conducting espionage breached a series of email accounts linked to government agencies in Western Europe. Now, it says the group was actually able to remain undetected for a month after gaining access to email data from around 25 organizations in mid-May. Microsoft only discovered the breach following an investigation mid-June after being alerted by customer reports about abnormal mail activity. Coming up, the Saudi-backed PGA Live Golf merger comes under fire in a U.S. Senate hearing. We'll bring you the details next. And this is Bloomberg. The conversations that matter and the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, pain for the PIF as it emerges that Saudi Arabia's sovereign wealth fund lost about $11 billion on investment activities last year as global markets sank. Now, let's get the details from Matthew Martin, who heads up our Saudi Arabia bureau. Matt, thank you for joining us. So what more can you actually tell us about the loss for the sovereign wealth fund?
Hi, Francine. Well, yeah, look, as you say, the Sovereign Wealth Fund made this big $11 billion loss from investment activities over the course of 2022. That pushed the fund overall into a big loss, a turnaround from making big profits in 2021, which was all driven by the stock market gains that it had in the post-pandemic era. That obviously turned to losses last year as investors started to worry about the big geopolitical concerns and rate rises, and that had a big impact on markets. I mean, it's probably worth noting that the markets have recovered this year, so PIF is probably recovering some of those losses that it took on 2022. But I suppose the other interesting thing to sort of put this in context is that even with losses last year, it doesn't seem to have done anything to dent the PIF's appetite for going out and spending money and making a big splash on international deals, just like the PIF, the Live Golf and PGA merger. And we also see PIF putting money into deals all around the world at the moment.
So, Matthew, let's turn to the PGA Live tie-up, which was criticized in the US. First of all, take a listen.
Americans very simply deserve to know what this agreement means for the future of golf, as well as for the future of the Saudi Arabian government's investment in sports and other autocratic regimes that may choose to do the same.
So what exactly is going on there, Matthew?
Well, look, the PGA and Live came to this deal really as a way, and I think this came out from the hearing yesterday and from some of the evidence that was gathered as part of that. It was really all done to try and put an end to this, these long, costly and potentially damaging lawsuits between PGA and Live. So bringing the two golf tournaments together was a way of trying to end that. However, it's possibly brought even greater scrutiny as this now gets a lot of political interest. There's a lot of concerns through the hearing yesterday about how much will, if players in the PGA or American citizens want to criticize Saudi Arabia and its human rights record, is the PGA going to get involved in trying to silence that criticism? We've seen examples of some of that with sporting events that get linked to China in the past, so there's a deep concern around that. And I think really what it all demonstrated is that the Saudis still have a fairly bad reputation in the US. And getting this deal through in the face of some of that political opposition will probably be quite a difficult challenge, and will be a big lobbying effort from the Saudis to get this done.
Thank you so much, Matthew Martin, our Saudi Arabia Bureau Chief. Now, be sure to subscribe also to Bloomberg's In the City podcast that I host along David Merritt on Apple Podcasts, Spotify, or wherever you get your podcasts. Today, we actually have a bonus episode featuring the former Bank of England Monetary Policy Committee member Adam Posen. Let me tell you, he does not mince his words. He tells us that the central bank needs to keep raising rates, and he talks like 7% for terminal rate is really something that we could be looking at. The other chart outside, of course, the Bank of England and what that means for sterling is the CPI data out of the US. And now, thank you, Dan Curtis, for bringing me this chart, which is basically looking at the VIX spiking ahead of the CPI, even though it's expected to ease somewhat today. This is Bloomberg.